Get all my settings pulled up here. Hi, everyone. Welcome in. Just hang tight for just a bit. We're going to wait till our attendees list kind of stables out here, and then we'll get started. We're up to 38, Jennifer. We're growing.
Come on, folks. Come on. All are welcome. Come on in. Oh, we have a hand raised already.
Ooh. Oh, ooh. They're like, never mind.
Oh, come on.
We got an error code for going live, so we'll try one more time just to make sure. There we go. Just needed an additional push there. All right, it is 1:31, so we'll go ahead and get started. Hi, everyone. Welcome in. Thanks so much for joining us today. We have Jennifer Vail with us today for our All Things ECE with ELV webinar series. She's going to be covering the Employee Retention Tax Credit, so ERTC for all those acronyms that we always have in the ECE field. She's a senior associate with Civitas Strategies, so we're partnering with them for 4 different webinars this month, so starting this Friday through the end of the month as well. So we're super fortunate to have her and her team on with us this month. My name's Melena Miner, for anyone who is new here and does not know me. I'm our Membership and Marketing Coordinator with ELV. If you're new to ELV in general, we're a 501c3 nonprofit helping streamline administrative duties for childcare providers all across the country. So from Hawaii to New York on their day-to-day admin duties. Here's just a quick snapshot of some high-level features that Alliance Corps does help out with and cover. One fun fact about Alliance Corps currently, for anyone located inside Colorado, we have received the Daniels Fund Scholarship. So anyone located within the state of Colorado does receive Alliance Corps completely free for a full year. It's limited to 50 members. So some of those spots have filled up already, but if you've been kind of waiting to make that jump into a childcare management system, but are interested in doing so, definitely feel free to reach out. I'd be happy to give you a demo and kind of answer any questions you have on that. We do have the mobile apps as well for kiosk staff, parents, and friends available on Apple, Google, and Amazon devices as well. So if you're not already using those, definitely be sure and get those downloaded. Really does just put the system in the palm of your hand for sure. And then additionally, as most of you probably are aware of, our resource platform is also free for anyone in the state of Colorado. It's kind of a one-stop shop knowledge hub for anything ECE related to discounts and savings, templates, assessments, family childcare toolkits, you name it, it's on there. So if you're interested in doing so, that link will also be in our post-webinar messaging. And before I hand it off to Jennifer to take it away today for today's topic, I do want to remind everyone that this session is being recorded. You'll get the copy of the recording in the post-webinar messaging, the presentation slides, and some resources from Jennifer as well. So be sure and keep an eye out for that. And you'll get a 1-hour training certificate sent afterwards. So thank you so much, Jennifer. Take it away.
Sounds good. Everybody bear with me. How are we doing with the share? Let's see. Everybody good?
Perfect. Looks good.
Fantastic. All right. Well, thank you all for joining me today. Good afternoon. I want to thank ELV for having us today and want to welcome you to today's presentation. So it is on the Employee Retention Tax Credit, otherwise known as ERTC. We're going to have some question and answers coming in, questions coming in through the chat while we're giving the presentation. If you can think of anything that you'd like an answer for at the end, please put it in the chat and we'll be sure to address those. And if for any reason we don't get to your question today, we will have a means of following up with you. So please feel free to ask any questions that you would like. All right, so before we begin, I just have to read the disclaimer slide, so everybody bear with me. So the disclaimer is that the information contained here has been prepared by Civitas Strategies Early Start and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies Early Start team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship, and reproduction of this information is expressly prohibited. All right, so we're going to do a deep dive today into the ERTC. Happens to be a topic that I'm pretty passionate about because it really can be a great reward to childcare businesses. So what we'll do today is we're going to discuss exactly what it is. We're going to review how you can determine if your business is eligible for the credit. And within a few slides, I'm going to share the reason that this credit is so attractive for Colorado childcare providers. And it's important to understand the financial impact of the credit. As I said, some large businesses, this will be substantial, but any business with W-2 employees can or may benefit. So once you've determined the eligibility, we're going to review how you go about calculating your credit and then how you will file. So this is for me, very exciting stuff. All right, so what is ERTC? It is a federal tax credit, meaning that it's issued by the IRS, and it's created to compensate employers who had payroll expenses during some of the most challenging times of the pandemic. The credit itself is determined by examining payroll expenses from March 13th, 2020 through September 30th, 2021. So we're looking at that particular time period on there. Filing the credit is easy once you understand the calculations that need to be made. It's not the same as applying for PPP. For a PPP loan, it's not a program where you need to get forgiveness. It's a tax credit, and it's based on the payroll cost. And if you do not have any outstanding balance with the IRS, it will come to you in the form of checks per quarter that you file. Whichever quarter you file for, you'll receive a check. If you happen to have an outstanding balance with the IRS, it comes off of that outstanding balance. So good news all around there. Now, there is one exception to that, the March 13th, 2020 to the September 30th, 2021, and that's what's called a recovery startup. So if you're joining us today and your business started after February 15th of 2020, while you wouldn't qualify for the standard ERTC, you may qualify for what's called a recovery startup, which are the last 2 quarters of 2021. So stick with me if you're a newer business, because there is something available for you. So how are we going to determine though if your business is eligible? So there are 3 ways to determine eligibility. And I'm going to jump to the middle of the slide. Let's start off right in the middle, because this is where the circumstances of mandatory closures and partial business cessation for Colorado business owners offer benefits. So the fact that you had to go through those difficult times of having a mandatory closure really works to your advantage when it comes to the ERTC, because it means you do not need to qualify with revenue reduction. So in the states that did not have mandatory closures, the businesses had to qualify by having significant reductions in revenue. And we can see that on the left-hand side of the screen. So if your area had a mandated closure of any kind, and you did not comply with that closure, you will have to go through the eligibility in regards to revenue reduction. So if you didn't comply, you are going to have to go back to the other way there. So, all right. So for you folks, the actual terms of what we're going to take the revenue reduction, it's the same, both, how should I put this? Both eligibility factors will receive the same type of calculations and the same type of credit. So it's not as if one or the other is more attractive. It's just nice that the fact that because of the mandatory closure, we do have the opportunity to not have to worry about the revenue reduction. So one thing we want to be really careful about, you see this at the bottom of the screen, exceptions for PPP or FFCRA be strategic. What that means is that when we evaluate the time period from April 13th to 2020, September 30th, 2021, we need, when we examine the payroll, when you examine your payroll, you're going to need to back out PPP and FFCRA any time period that your payroll was covered by one of those two programs. So if you received your PPP, let's say for 6 weeks, when you calculate your payroll, we're going to back out that PPP because we can't, so, double dip, so to speak. And it's the same thing with FFCRA. So if you've applied for FFCRA credits, you cannot count that payroll towards the ERTC. So we just need to make sure that you remove those wages. All right, so here's the slide that gets me excited for Colorado. So basically, if you had that mandatory closure, partial business cessation, during the time period of March 20th, so just a couple days after when ERTC actually officially started. So if you had that mandatory closure from March 20th, 2020 to April 15th, 2021, you will automatically qualify as long as you observe that order, which is really a wonderful thing. Fantastic. If, again, you'll have to default to the eligibility rule if you did not comply with that. So the closure eligibility rule ended on April 15th, 2021. So that means that starting from April 16th to September 30th, 2021, which is September 30th is when ERTC officially ends, where we can claim for ERTC. So from the 16th of April to the 30th, you will have to address the revenue reduction as if you did not have a mandated closure. So it is fantastic that ERTC will be available to anyone with the mandatory closure. Again, March 20th, 2020, April 15th, 2021, and then starting on April 16th, 2021, we're then going to need to look at revenue reduction. And we'll talk about what those revenue reductions actually are. So we can definitely go through that. So, and in order to qualify with the revenue reduction, you will end up needing from that time period to have basically at least a 20% reduction in revenue to qualify for that April 16th through September 30th time period there. So let's get going on this. Okay. Oops, excuse me. There we go. I said that this is very, very touchy. So here's our example of examining revenue for 2020 and 2021. So as you can see, you need to determine what your gross revenue was for all 4 quarters in 2019. So this is important. We're going to take our 2019 gross payroll and gross revenue, excuse me, and we're going to compare it to our gross revenue of 2020 and 2021. So 2019 versus 2020 and 2021. So if we take a look here and we see the first, our example here is that 2019 revenue was $100,000 across the board for every quarter. So the second row is where we're addressing the revenue reduction for 2020. So you'll see in Q1 of 2020, the program didn't begin yet. It started March 13th. So the majority of Q1 does not count for ERTC, which is why we're not comparing any revenue there. So in this particular revenue, I have to say that any fall off in revenue would be very hard to hit the 2020 requirement, because the requirement for 2020 is that you have to have a revenue decline of at more than 50%. So just keep that in mind. For 2020, we need to have a loss of revenue of more than 50% to qualify. The first quarter that happens in 2020 is when what they would call the trigger or ERTC starts. So let's look at this example. If we look at 2020 gross revenue and we go to Q2, the gross revenue was $48,000. It had a 52% reduction in revenue. So that qualifies. Fantastic. When we go to Q3, okay, we've done better and we only have a 25% reduction in revenue, but we continue to qualify. So in 2020, we needed one quarter that was at more than 50%, and then the following quarter should be at least a 20% reduction. So in this instance, that 25% reduction still qualifies you for the ERTC. And then an interesting thing happens. With the ERTC, the quarter that follows, the last quarter that was qualified, right? So we know Q3 we were qualified. And if we go to the gross revenue 2020 and we look at Q4, wow, we had a little bit of a rebound. We had a 5% increase, but you can still continue to claim ERTC for that quarter because it's considered to be a recovery quarter. So remember, we're going over this in case you have not complied with mandatory closures or you did not have a mandatory closure. This is how these calculations come about. Now, what's nice is that in 2021, the rule is that you only have to have a 20% or more reduction in revenue across the board. So we no longer have to worry about hitting that 50%. So those who had the mandatory closure and are going to be looking at that time period from April 16th to September 30th, you will only need to have that 20% reduction in revenue. So if we look at our example in 2021, the first quarter, there was an increase. So it does not qualify. There's no ERTC that can be claimed for quarter one. Quarter two, we had 22% reduction in revenue. That counts because in 2021, it only needed to be at least a 20% reduction. And then in quarter three, great, there's a rebound, great for that business owner. And they still qualify for ERTC because it's a recovery quarter. So it follows the last quarter that had the actual reduction. So in this particular instance, this business in 2021 would be able to claim ERTC for quarter two and quarter three. Now we get to quarter four, not eligible because ERTC ended September 30th, 2021. So that is the end of the eligibility, and therefore we would not be claiming anything for the fourth quarter. So now we have done well there. So let's move on here. Okay, so what is the actual benefit of filing for ERTC? And I'm very passionate about this. I get very excited because in 2020, and bear with me, the numbers will sound a little weird at first, but we're going to look at some examples. So in 2020, you can claim up to 50% of $10,000 in wages per employee for the year. So per employee, the maximum amount of credit that you can receive is $5,000. So we have to cap employees for the year of 2020, or actually from April 1st, 2020 through December 31st, 2020. Any employee that exceeds $10,000 in that time period, we do have to cap those wages. So we will have to only claim $10,000 worth of those wages, which is why the maximum annual credit for per employee, the maximum could be $5,000. What happens in 2021 is that we're actually able to claim up to 70%. So we only claimed up to 50% in 2020. Now in 2021, we get to claim up to 70% of wages. And the $10,000 cap is per quarter per employee. So where the $10,000 was for the whole year, now in 2021, not only do we get to claim a higher percentage of the payroll, but we also, our employees get capped at $10,000 per quarter. So 2021 has a far greater advantage in terms of the actual, let's say, payoff. So that means that in 2021, the maximum quarter, because it's 70% of up to $10,000 in wages, the maximum credit per quarter per employee is $7,000. So that means that if you have an employee that has had at least $10,000 in wages for each quarter, the annual maximum is $21,000 per employee. So if you stop and do a little bit of calculation in your head and think about what your quarterly payroll is, this is where you can really, in both instances, 50 cents on the dollar, 70 cents on the dollar, both very, very attractive credits. So without a doubt, certainly worth filing for. So here's what we're going to do. We're going to take a look here and we're going to talk about how you would end up calculating, right? So we know what the benefit could possibly be, but how do you come up with that calculation? And I have to stress, it is not difficult at all to do. It's a little bit of paperwork, but I want everybody to hang in there with me and have the confidence that you can do this. It's not difficult. So let's look at this example. So we are looking at both 2020 and 2021. This is one employee, and we see the gross wages. So we're not looking at net wages, we are looking at gross wages. So we look at the gross wages, and everything is broken down per quarter. So we are always going to be filing per quarter for ERTC. So gross wages in 2020, $5,000, quarter one doesn't count because the program didn't actually start officially or really roll out until quarter two. Okay, so with this employee in quarter two, 2020, there was $5,000 in wages. That means that employee alone is a $2,500 tax credit. Quarter three, same exact thing, $2,500 tax credit because in quarter three, that employee earned $5,000. Now, what happens in 2020 with quarter four? Well, we know that per employee for the year, there's a $10,000 maximum per employee. So we actually don't claim in 2020 for that particular employee. We don't claim any credit because we've already maxed out at the $10,000 at the end of quarter three. So the total credit for this employee, per employee, one employee, is $5,000. Let's look at 2021, again saying, hey, we know that 2021 is far more equitable when it comes to the fact that there's a $10,000 cap per employee per quarter. So what does this mean? In 2021, the employee for quarter one still earns the same $5,000. However, you as the child care provider, the owner of the business, would be able to claim $3,500 for that employee. And as we go across the quarters, we're not maxing at this employee at $10,000 a quarter. So in each instance, we get to claim the $3,500. And then if we take a look at this, in this particular instance with this employee, the total credit would be $10,500. Now we don't count quarter four because the program did not run in quarter four, but look at the difference, more than double in 2021. And that's why anyone who had the mandatory closure and knows that they can file for 2020 and up until April 15th of 2021, looking at those, that possible potential tax credit, it really does make sense to go ahead and file for that last from April 16th through September 30th. There's a big win to be had. So I would hate to see that somebody just took the automatic eligibility with the mandatory closure and didn't look into their reduction in revenue for that last time period, because it can be very, very lucrative. So that is definitely something that I would like to kind of drive home. Now, when it comes to actually calculating the wages, we're going to walk through that. So what you would do is you would get your gross payroll per quarter from your payroll company, and they may give you a little bit of pushback. That's okay. You're just going to say to them that you need per employee per quarter the payroll. Once you get that payroll for the quarter, we do have to make some removals of wages. So we cannot claim the owner, and we cannot claim any family member of the owner. So you would have to back out the payroll for those individuals. So we're not going to count those individuals in the payroll dollars. We're not going to count, once again, PPP. So you're going to determine what date did you use your PPP for? And that's actually found on your PPP forgiveness paperwork. So you would go there and you would back out those wages that were covered by PPP. And you do that for both years. If you have 2 loans, you'll make sure that you back that out. You'll back out if you did receive anything on the FFCRA credit, you would back that out as well. So now we've got a number, right? So we've got the payroll number, we've backed out, and now we can just calculate that credit. So now we can look at that gross payroll, all of those employees added up per quarter. And for 2020, you're going to get a 50% credit. And in 2021, you're going to get a 70% credit. So there is an awful lot to be had here. There's really a great deal for the majority of business owners that have W-2 employees. So very exciting here. You can see that this can be so lucrative, and I really am encouraging everyone to participate. So, all right. So now you find out how much that you're eligible for. We know what our credit is going to be. How do we get that credit? Well, what you do is you're going to self-certify that you're eligible. That was what you just did, right? You went in, you checked whether it be the mandatory closure or the reduction in revenue. Document that. So you're going to want to keep your spreadsheet with your payroll and any calculations that you did to come to the conclusion that you are eligible. Keep those records. So you'll want to keep those records. You do not, however, submit that information. So you're not going to be sending the IRS any of the calculations. You file with the IRS. They know what your revenue was. You pay your payroll taxes. They have a very good idea of what your payroll is. You do not have to give them that information in any type of document unless it's requested. So just so you know, you're not going to be submitting that, but you are going to be keeping it. You definitely want to do that. And again, when we do that payroll, just make sure to take out the owner and family, take out that PPP, take out that FFCRA, and you'll really have covered all of the requirements to file for that credit. So once you have those quarterly credits and you know what that amount is, you've taken that payroll, 50% on the dollar for 2020, 70% on the dollar for 2021. Once you have that, you take those numbers and you actually use the 941X form. 941X form is used for many different things. It's a tax amendment form. However, for ERTC, there actually is very little of that form that you fill out. So it could be very intimidating if you saw that form and thought, how am I going to go about filling out all this information? It's very little information. And you can find that information very easily through a Google search. You should not be intimidated. However, if you don't feel comfortable, you can always contact your tax preparer. Some payroll companies file this for you. One thing I'm going to say to be very careful in that there are companies, predatory companies, that will offer to do this filing for you. They'll do the calculations, they'll do the filing. They'll even promise that the IRS, they can expedite things through the IRS, which is not possible. No one can expedite through the IRS. They're going to charge you a large percentage of your tax credit. And sometimes it can be as much as 25%. And you have to lay that money out before you've ever received your tax credit. Those are very predatory practices, and this is not difficult to do. If you don't feel comfortable filling out the 941X yourself, then what you can do is gather all that data and then pay your tax preparer to file the form for you if you don't feel comfortable. But why give 15 to 25% of your tax credit? Why would you give that to a predatory company when you really are capable in many ways of being able to do this yourself? So I just urge everyone to, before you sign up with a company, really give it some thought about how you could accomplish this by yourself, and you can receive those tax credits for your business in whole. So, all right, once we file the 941X, what happens is, again, it's filed quarterly. and it's mailed in to the IRS. Now, what's happening right now? ERTC is eligible for any W-2 business after backing out those things that we need to make sure that we've removed. Any W-2 business in the United States. So you can imagine the backlog that still is occurring with these ERTC claims. So it actually is taking 6 to 9 months to process. And keep in mind, you're filling out a 941X for every quarter. So you are going to you're going to be sending them in for every eligible quarter, and then you're going to receive a check for every one of those quarters. So you'll have to be a little patient there. It is going to take some time to get that credit back. But as you can see, just from that one example that we looked at with the individual who had the $5,000 in gross payroll, those are some very nice tax credits per employee. So stop and think about that monthly payroll. Think about how many W-2 employees you have. Think even after backing out your PPP loan that you really, most businesses have a nice amount of money that due them that's worth it for filling out that credit, for going through the process of filling out the documents and doing this. The credit can be so beneficial for your business. And we know that childcare providers, having come through such a difficult time, this exists to help you with some of the most difficult times of the pandemic. And there's no reason that you shouldn't take advantage of it. So I definitely really advise you to look into this. If you don't qualify for whatever reason, so be it. But it's certainly worth your while attempting to calculate and see if you would be eligible. So by all means, I cannot recommend strongly enough that everybody do this. So, all right, so now let's see if we have any questions. And if I don't have an answer for you today, we will get back to you with an answer. So what does that look like, Milana? Do we have any questions?
Yeah, so some of them that came in earlier were more relating to family child care homes. So Elsa directed them to come back for the webinar in 2 weeks on that.
Yep.
One asked, is it available for nonprofits?
Absolutely. So nonprofits are 100% eligible. There's nothing disqualifying nonprofits. And
if you got PPP loan, are you still eligible?
You are, right? So you're going to back out that time period. And the majority of childcare providers, PPP covered, this is just a generalization, but it usually covered about 6 weeks worth of your payroll. So if you think about that entire amount of time over the course of 2020 and 2021, you still have a lot of eligible payroll left to receive credit on.
Perfect. I'm a family home provider. Can we apply?
So it is only available for employers that have W-2 employees. Mm-hmm. However, I'm going to throw in the pitch for 2 weeks from today. We're doing a webinar on FFCRA, and that stands for Families First Coronavirus Response Act, excuse me. And what that is a credit that is available to childcare providers. It is available to the owner. You do not have to have W-2 employees. And it basically will allow you to get a payroll credit or a payroll credit or a credit for yourself for any time that up to 80 hours that you were out with COVID, that you had to quarantine due to COVID, that you cared for an individual of your immediate family that had COVID, or you were home with children because they had to be homeschooled. So think, if you are a home provider, think about those circumstances, the same time period. So we're addressing from March 13th, 2020 through September 30th, 2021. We can only claim up to 80 hours, but 80 hours, if you fall under that time period and you have at least 80 hours that qualify, that meet one of those qualifications, you can receive up to 80 hours of credit. And this is not just for family providers, but of course, if you happen to have a situation where you don't qualify for ERTC, you have W-2 employees, but you don't qualify for ERTC, go back into those payroll records and you're going to look for the credits that you could be due based on those types of situations, whether it be having an employee or yourself having COVID, quarantining due to COVID, caring for an immediate family member with COVID, and also staying home for with the at-home schooling. So 2 weeks, am I correct, Milana? 2 weeks from today?
Yep.
2 weeks from today, same bat time, same bat channel, as they would say. I'm aging myself by saying that. Yeah, so you'll be able to join us for the FFCRA. So
perfect. And then another one is, where is this money coming from?
Yeah, so federal tax. So it basically is the government stating that they understand that businesses paid employees during the most difficult times of the pandemic. So this is federal tax money. Again, doesn't have to be repaid. It's not anything that you have to apply for forgiveness. It literally are really what they are refunds, right? So it's basically giving you refunds from your payroll that you file as if you would file for any other tax claim.
Perfect. What is the credit for providers that started up after 2020?
Yeah, so if you started up, you would have to have started after February 15th of 2020. And if that's the instance, then you will only be claiming from, you're going to claim from September 30th. I'll make sure that I've got my times correct here. Yeah. So I should say Q3 and Q4. So from July of 2021 through the end of 2021. So that's extended past when ERTC is for existing businesses. So those last 2 quarters, and it's the 70 cents on the dollar up to a $50,000 credit. So you have to have less than $1 million in revenue, annual revenue, in order to qualify. But if you did open up after February 15th, 2020, you will be eligible, because remember, you don't have any 2019 revenue to look at. So in that instance, you would be looking at those last 2 quarters of 2021 and getting 70 cents on the dollar.
And then is there a deadline of when this needs to be done by?
So it's like any other tax amendment, which is 3 years from the time that you filed. So you'll want to check with your tax preparer on that. Make sure that you're within that time period. But basically, we should still be able to get credit for providers. You know, we still have a healthy amount of time, right? So that's why I encourage everybody to go ahead and make those calculations.
Do you calculate just the traditional revenue, or do you have to have an in-state COVID relief grants to center received?
One more time.
Yeah. Do you calculate just the traditional revenue, or do you have any state COVID relief grants the center received? Does that make sense?
Okay. So if they're federal grants, you have to claim them as revenue. So you will have to take your federal grants and include that. You're not going to include any of your local, and you're actually not going to include your PPP in that revenue. So but you will have to, any federal grants that you have, you will have to claim those as revenue.
If there was only a mandatory closure from March 2020 until July 2020, do you automatically become eligible?
So yeah, absolutely. So you would become eligible for that time period without having to look at revenue reduction. And then you would look at revenue reduction after that July time period. So if you weren't eligible for that mandatory closure or partial cessation of business, if your mandatory closure ended sooner than what we were talking about before, absolutely, you're still eligible for that time period. And then you would look at that revenue reduction, right? And it would be in the rest of 2020, it would be the 50 cents. Your revenue reduction would have to be more than 50% in 2020 and more, at least 20% or more in 2021, but you certainly would be eligible for that.
Perfect. And then we have one that I am a family child care provider with a W-2 employee and received stabilization funding through state child care assistance program during the pandemic. Do I still qualify?
I believe you do, but could we get a favor and get that email address in our chat if our provider doesn't mind? And let me just get some really get some qualifying information on that. I'd be happy to get back in touch.
Perfect. Let me check our Facebook comments here if anything came over there. All right, we're caught up so far. Feel free to send any other questions over that have come up as we went through those also.
I'll advance to the next slide while they're doing that, because I'm going to do my pitch here.
Go for it.
Here's my big pitch. So I want to thank you so much for joining us today. Really, really appreciate it. Now, if you're interested in learning more, if you have more specific questions, if you have anything that you would like to discuss, ELV has made it possible for you to have free business coaching. And that free business coaching is done by my company, Civitas Strategies Early Start, the company that I work for. And it's basically a half hour at the minimum devoted to your questions, your situation. So by all means, please, please register for business coaching. Go to the website, www.elvc-cses.com. You're going to see a link there that you register for business coaching. You're going to get to pick a time that works for you. And we definitely have times available. A lot of the employees of Civitas Strategies Early Start are in a different time zone, and we accommodate your time zone. So that is not an issue whatsoever. This is a free service that is being made available by ELV. So there's really no reason to not take advantage of it. If you had a question that didn't get answered today, if you have a specific situation, I will also say that individuals that become involved with business coaching, we do have the opportunity in many instances to help you through the process. We are not tax preparers, but what we can do is we can offer you some assistance. It requires a little bit of homework on your parts, because what I would be asking is for you to gather some of that payroll together, get it in order, get it in quarterly increments so that we have our payroll by quarter. And if you're going through coaching and that's the situation, we really are more than happy to help you with that calculation, help you fill out the form. I can walk you through it. I'm very well may be the person that you speak with. And we can make that happen for you. If you feel like you need some assistance, go through the business coaching. It won't be overnight. You know, my hope is that we have a lot of people that respond to business coaching, because it really can be this great free resource, and it doesn't end at one coaching session. So ELV has made it possible for there to be coaching beyond just that first session. So if we have a discussion and then you need to come back and talk to me about it some more, that's not an issue. You can do that. And that's all made possible by ELV. So by all means, please, please take advantage of the free business coaching. Again, I might be one of the people that you speak with. I might not. If you don't want me, I'll find somebody else to help you. So don't feel that you have to be stuck with me, but it's certainly worthwhile. And then I also, I hope that you'll join us October 21st. Is that the correct date, Melana?
Yep, 2 weeks from now.
Great, thanks. So same time, 1:30 Mountain Standard Time. We're going to have that webinar on the other tax credit, Families First, Corona Response Act, FFCRA. And if you have taken our webinar today and you actually would also like to take it in Spanish, if you feel more comfortable, sure, this same webinar will be presented a week from today, next Friday, in Spanish. So also, if you happen to have any friends, if you know any other childcare providers who might like to listen in Spanish, by all means, I hope that they join us.
Absolutely.
So
all right. Any other questions that were coming through, they just sent emails so we can reach out to them at a later time on case-by-case specifics.
Fantastic.
Otherwise, yeah. Thank you so much for your time, Jennifer. We truly appreciate it.
You're so welcome. I'll turn everything back over to you folks, but it was a pleasure speaking with everybody today. I thank you so much for the wonderful attendance, for taking your time. I guess nap time is over, but everybody's gotta go back.
Everyone's got to go, get them back to their Friday. Yeah. If anything else comes up, feel free to either put it in our chat or send me over an email. I've got my email in the chat as well, or also put in a link to the coaching itself if you're interested in that. Otherwise, thanks again, Jennifer. We'll give everyone a couple minutes back in their Friday. Appreciate it. Have a good one.
There you go.
We'll see everyone next time.
Folks.
Bye, everyone. Have a good one.
Bye.